The Bank of Canada dropped the overnight rate by 0.5%. We saw this coming because of the buzz around dropping interest rates this year that started back in June. 50 basis points is another indication that the Bank of Canada is gaining confidence in a slower economy with inflation coming down, which is what prompts a drop in the overnight interest rate. Because the last time the bank dropped the rate by 50 basis points was back in March 2020. That was back when they held the overnight rate at 0.25%, which lasted for 2 years. And those 2 years were pivotal to where we are today. We saw the average home price climb up to $1.3 million. When you stop to think about that, that was actually an increase in the average home price by 44%, which is insane. This also added to the inflation problem that had inflation go up by nearly 6% during that time. And that inflation problem is what the Bank of Canada has been trying to solve over the last couple of years. And if you ask me, they reacted with these rate increases a bit too late. Inflation was already trending up for 12 consecutive months by the time they decided to introduce the first rate increase, which was only by 25 basis points. Granted, several more rate increases took place that led to the overnight rate of 5%. But this year, we've been seeing this come down. In June, July, and September, we saw 3 rate cuts of 25 basis points each. And today in October, the rate was cut by 50 basis points. This is great news that a lot of people are going to celebrate, especially people currently on variable rates who will see their monthly payments go down, home buyers looking to get a mortgage, and even home sellers too, because home buyers need lower rates to help with affordability, and home sellers want rates to come down. Not need, want rates to come down so they can have a larger pool of buyers looking at their home when it's up for sale, which leads to higher home prices. And you'll find out more about what I mean by that if you keep on watching. One of the reasons why the Bank of Canada is now deciding to do larger rate cuts is because they're starting to recognize that borrowing costs should be coming down more quickly. Borrowing costs is in reference to how much it's going to cost you to get a loan from the bank. How much interest do you have to pay to borrow the amount of money that you want or need? It's one of the main reasons that helps to keep the housing market moving. It's not based on how much money you have in the bank or how much you've got available for your down payment. The influencing factor that gets people deciding to buy real estate is how much you can borrow from the bank and at what rate can you get that money for. So in theory, it has very little to do with the discipline of how much you can save and how often you can save that money. Sure, you get the consistency of saving, and that helps to put aside a larger down payment towards your home ownership goal. But at the end of the day, the average buyer still needs to borrow a large chunk of money, so buyer motivation is key here, and the bank's overnight rate is what will determine buyer motivation. If the bank's overnight rate is high, mortgage rates go up and borrowing gets more expensive. Just look back at 2020. Higher interest rates meant for a lot of people larger monthly payments, which reduced the amount of money they could borrow. We saw in many cases that some buyers fully stopped looking at buying a home because the cost of ownership with high interest payments did not make any sense. And this lasted until 2022, and the goal to cut down inflation finally happened, which resulted in falling home prices. Mortgage rates went up and people were able to borrow less money from the banks. This is one of the reasons that caused home prices to come down. And guess what? There was no market crash. Home prices came down 15% from 2 years ago, but they're still up 44% from 4 years ago. A house that used to be worth $1 million wasn't worth $1 million anymore, which is great news for buyers. But the issue is that a large population of buyers typically purchase their home with less than a 20% down payment. That's a high ratio insurable loan, which means it's higher risk for the bank. The remaining 80 to 92% to buy that property would have to come from a mortgage. But as the Bank of Canada's overnight rate went up in 2022 and in 2023 with 10 consecutive rate increases, financial institutions became more risk averse. So what does that mean? We know that banks love to make money off of our money by charging us interest. The old saying is that it takes money to make money, but it doesn't mean that they're willing to take all of the risks. They're not just handing out mortgages to everyone that walks into the bank. That's probably something they stopped doing back in 2017, if I had to guess. When borrowers default on mortgages, banks actually lose money. They have to seize the property, which is what's known as a foreclosure. Then they work on selling it, usually at a price lower than market value. Then they ultimately end up writing off part of the loan in many cases because they cannot recover the entire debt. So to avoid this, the banks actually tighten their lending standards to minimize the risk of defaults on mortgage loans. They might ask for a larger down payment to mitigate some of the risk. Another reason why home prices came down is this. People were not interested in buying real estate anymore. High mortgage rates tends to reduce the demand for loans since the cost of borrowing is higher. So when this happens, people put off their home search, they delay it for another month, another year, or whenever mortgage rates eventually start coming down, sort of like what's happening right now. In January, people were getting fixed mortgage rates of about 7%. Today, the average rate is at about 4.7%. The average price right now in today's market is just over $1.1 million, which is actually 8% higher than the beginning of this year when the bank's overnight rate was at a peak of 5%. Now it's down to 3.75% as of today. So the change in the bank's overnight rate really has a way of controlling what direction home prices go. Rising interest rates mean lower home prices, but lower chances of qualifying for a mortgage. So then falling interest rates would mean rising home prices. Eventually. With the bank's overnight rate dropping by 1.25% so far since June, it's clear that we're in a period of transition in the real estate market. The balanced market that we're in right now is going to change. In fact, the current market is on the edge of being a buyer's market. In September, there were about 26,000 active listings on the market and also 5,000 home sales. So we have about 5.2 months of housing inventory, which means that it would take more than 5 months to sell through all of the existing supply in real estate. More listings on the market and lower sales transactions are the reasons for lower and falling home prices. Home sellers have to compete for the limited number of buyers since buyers today have way more options, especially in the condo market. The amount of buyers that are actively making an effort to buy their next home will change as we keep trending in this direction of falling bank rates. Eventually, this leads to a shift towards a seller's market. It's just a matter of time. This is a fact, and I know there are going to be people who disagree and say that the market is still going to crash because people have no money to afford homes that are supposedly worth $1 million and more. But the Bank of Canada considers this and also a few economic factors when they're making a decision on whether to drop or raise the key interest rate. One of them is inflation, which today is at 1.6%. The bank has a target inflation rate of 2%. And finally, after 5 months of the inflation rate coming down, it's finally below that target of 2% at 1.6%. This is a sign of a weaker demand and lower price growth throughout the economy. Canadians are not willing to spend for a good reason. I paid $2.54 for a Honeycrisp apple the other day, for crying out loud. So how can Canadians prioritize buying one of the most expensive assets they might ever have, such as real estate, when other living expenses are through the roof? The Bank of Canada reacts to this and reduces interest rates to encourage spending. Here's a bit of history I wanted to share with you that explains what direction the real estate market is likely trending. For anyone who was watching the market in 2017, you'll remember it was a peak period. Home prices reached new all-time highs. In fact, the average price went up 27% in 2 years from $609,000 to $775,000. The rise in home prices was one of the reasons that eventually sparked an increase in the bank's rate. Throughout 2020 and the beginning of 2021, home prices were more or less stable. We even had negative inflation during the second quarter of 2020. By 2022, home prices reached new all-time highs. The average home price in the GTA was $1.3 million. That's more than double the average price in just 7 years. Inflation reached an incredible 8.1% in June. That's a 5% increase in 1 year and almost an 8% increase in just 2 years. Between 2022 and 2023, there were 10 rate increases. Home prices fell and so did inflation. The economy slowed down. It took 27 months to finally bring down inflation to 1.6% where we are today. The average home price fell by 15% to $1.1 million. Now in 2024, the bank's overnight rate has been coming down since June. A drop in interest rates usually causes home prices to rise again before they ultimately reach new all-time highs. I'm not saying that we're expected to see home prices go up right away, but I do believe that we are going to trend in that direction and see a big change in the market. This is all going to be based on the reaction isolated to the Bank of Canada's interest rate, which then motivates home buyers, which then motivates home sellers. And this doesn't even consider how the average Canadian home price can go up as a result of the ongoing issues with supply constraints and growing population and urbanization if there's a strong job market. The next year is going to be very interesting. Home buyers and sellers will be looking for opportunities. And to keep updated with the market, hit subscribe if you gain value and learn something new today. New videos are coming out every single week with the best tips to help you reach your real estate goals. I'm Fred Tam, and thanks for watching this episode. See you in the next one.